show right now. William, hi, good morning. Great to have you on the show. And I guess, William, more than the Fed, the talking point this morning is Trump and Xi Jinping's meeting after a long, long time of 6 years. And it seems like they seem to be reaching some middle ground. And I mean, things are looking up at least.
Well, after all this time, we're back to where we started in some sense, because in the interim between the meetings in Zurich and London, we had this the China having a conniption about its export controls, and then the Trump having a reaction of raising tariffs. So now we're back to where we were when the talks first started, which is China has yet to restore, but they promised to restore the supply of rare earths and promised to fulfill their obligations to buy more soybeans. And yet we have yet to see that. And the U.S. is settled for a TikTok deal. And a bunch of promises, and we still haven't gotten any assurances that we can actually enter the China market with financial services and other such things. So there's a lot to be discussed, and so we have agreement for agreements, and that's about all we have right now. But we have great political optics.
Right. William, hi, good morning. This is Harshya. So give us the sense, what does this mean going forward? Does this mean that Trump, in your opinion, will bite the bullet even when it comes to other geographies? Is it just China specific? Give us a sense around that.
The kabuki dance with China is very different than the ones with other countries, because China and the U.S. truly are the largest economies in the world, and we have to settle on some kind of framework from which we can frame the 21st century needs of trade. But other countries, like India, for example, it's been a little bit easier to negotiate, although even India has proven to be an issue, because India also wants to balance several of its own domestic goals. India wants to continue to buy Russian oil. It continues to want to trade with China, and it wants to have U.S. Western investors come into India to expand its tech sector. So India wants, in many ways, a whole bunch of goals, and they're trying to negotiate that narrow line of balancing U.S., Russian, and Chinese interests. But other parts of the world, ASEAN, where the president has been negotiating like crazy, he's actually managed to nail specific deals with South Korea. The Japan deal seems to be well on its way. And there, I think we're much closer to real bilateral frameworks. And I think that's the shape of the world trade order to come. Much more in the way of regional and bilateral deals, more duplicated supply chains so that we can have safety and soundness in supply chains and not be vulnerable to the monopolies that we had before with globalization version 1.
William, coming back to the Fed, though, while it's been, pretty much on course of a 25 bips cut that one has seen, well, what did you make of the commentary? The fact that they are very much stating in as many words that this is the last of the rate cut that you're going to see this calendar year because of, the U.S. government shutdown and the kind of pressures that it brings about on the economy.
I think what you saw in the Federal Reserve press conference was that Chair Powell was trying to, again, toe the line with a bunch of a very divergent FOMC, the Federal Open Market Committee. You have a large number of members, probably about 7 or so, who want to keep rates exactly where they are, or perhaps even raise rates. And you have others that are trying to lower rates. And I think that tension has gotten greater now that the data has been cut off. And as you said, we're flying blind, we're driving blind in a deep fog. And the optimal thing under uncertainty when you have like that is to slow down. And even that he didn't want to commit to because the data could come online again. And also, it wasn't clear how much tension there was at the FOMC meeting. You saw the vestiges of the extremes with the St. Louis Kansas City Fed president wanting to increase rates, and Mr. Myron wanting to lower rates by even larger amount of 50 basis points. That extreme, I think, reflects the growing tension within the committee, and Chair Powell's got a tough job to try to come to a consensus.
And what next, therefore, William? You'll start to see liquidity conditions likely ease, and this is at a time when equity markets are at their all-time highs. Pretty much all asset classes have rallied. So give us a sense on what that means for asset classes as well as for equity markets in particular.
That's a great point. In fact, I think what you heard that was most important that's been underreported was that the chair Powell said that we will likely end the quantitative tightening and start to at least allow the runoff of the balance sheet to acquire more treasuries rather than allowing the balance sheet to continue to shrink. That is telling you that the Federal Reserve is getting more and more concerned about the tightness in the short-term credit markets, the repo markets, as it were, and he wanted to have more liquidity put in there, and ending quantitative tightening or possibly even engaging in quantitative easing might be the next step in terms of allowing the Federal Reserve balance sheet to grow, say, at the same speed of GDP, so that the ratio of the balance sheet to GDP stays about unchanged. That is the target I think the Fed is going for. That is another form of easing. So in that way, instead of lowering interest rates, the financial market and financial conditions could be eased through the balance sheet. And that's something that will help stimulate lending and stimulate at least the markets themselves. Now, as far as the stock market is concerned, a lot of concern has been expressed that there's been overvaluation, especially in the AI sector. Chair Powell made it very clear that he felt that a lot of the growth underlying the U.S. economy was coming from the investments in AI. He didn't say that that was wrong. In fact, he even said we're looking for productivity changes, and businesses are having to decide whether AI will be allowing them to improve productivity or not. That's something the Federal Reserve is not going to make judgment on, but he's trying to say we will take advantage of that increased productivity because that's a disinflationary force that will calm the inflationary fears and allow us to continue easing monetary conditions to allow the labor market to come back stronger.
Right. Okay, William, thank you so much for all that perspective. Great to have you on the show as always.
Thanks for having me.